This is Retirement Success with Steve and Elizabeth Holland and me, Todd M.J. Schnitt. For over 30 years, Steve and Elizabeth have been protecting your wealth or helping you create the retirement income that you need by creating inflation-adjusted, tax-advantaged, customized plans, because your retirement may be 20 to 30 years of unemployment. The Holland Group Retirement Wealth Advisors has the experience to take you to and through retirement. So let's make the rest of your life the best of your life. Welcome, everybody. This is Retirement Success. I am MJ, Todd Schnitt, along with Steve and Elizabeth Holland of the Holland Group Retirement Wealth Advisors. And I want to start off with a question. Let me ask you something. Have you ever wondered if your financial advisor is telling you everything you actually need to know? Maybe you hear things like, you're diversified, you're doing great, stay invested. But are those the right conversations if you're, let's say, 62 years old and planning to retire next year? Today, we're going to pull back the curtain on some of the biggest advisors retiring next year. Today, we're pulling back the curtain on some of the biggest things advisors don't always discuss, from hidden portfolio risk to retirement income planning, taxes, and why your retirement could be affected more by when the market drops than how much it actually drops. Now, Steve, this is going to be a very interesting show today.
Yeah, it definitely will be, MJ, because, here's the big issue. Your portfolio may be riskier than you think. There's a phrase, we have a lot of phrases, right, Elizabeth, that we use here.
Yeah, we're old, so we have to figure out all those old phrases.
We've accumulated
a bunch of them.
A lot of phrases over 35 years. Here's one that we use all the time. No one in this room is 45 years old anymore.
Nope.
And I always say that to investors when they're invested with too much risk, and I include myself in that. Nobody in the room 45 years old anymore, because if you are 45, you've got 20 more years until you're 65. And if you're taking a ton of risk, that may be appropriate. One of the biggest surprises that we see is people actually saying, I'm conservative. Then we run a independent risk analysis on their portfolio, and there you go. They're invested like they're 45 years old.
Not so fast, smart guy. Yeah.
Right.
That's right. Not so fast, not so good at all. It's not because somebody may have intentionally misled them, like a broker, an advisor, a banker, what have you. It's just that, sometimes portfolios simply evolve. Sometimes you've accumulated all these different investment choices, all these mutual funds, all these different sub-accounts that are in your portfolio, and you've accumulated them over, say, a 20, 30-year period of time. And sometimes an advisor hasn't, what advisor is really going to have a serious conversation with their client about risk in a market like we've had, when a market keeps going up, up, up? No, they're going to enjoy the performance and say, hey, yeah, you're doing good. You're doing great. Hang in there.
Yeah, don't rock the boat.
Don't rock the boat.
Yeah, exactly.
Yeah, and that could be the worst advice.
No, I will tell you, all the stuff you just said, Steve, that is going to be so confusing for so many people, because they're going to feel like, hell, what am I doing here? What's going on here? When we talk to people and we see the look on their face, we know they're confused.
Now, did you say hell or help?
Well,
because this is a family show.
I probably did say hell. I didn't say go to hell, Steve. So whatever. So, okay. So people do get very confused on three words, right? Diversified. We know what it means. But listen, when we talk and when I ask someone, tell me how you are diversified. You know the answer is, you guys? I have a little bit of here, have a little bit of there, they're scattered all around. That is the answer I get, honestly, which is so frustrating, because that tells me that the individual, the investor, really don't know if the portfolio is diversified and what's the diversification means to them,
right,
and how it's done.
Especially if they're in things that have names like a target fund, a target 2030. It just tells them, okay, I'm going to retire in 2030. It doesn't tell them what's in their portfolio. Or a long-term growth plan or an aggressive growth, what have you, they still don't know what's in the portfolio.
No, they don't. And of course, you meet the people who say to you, I'm conservative, which means I don't want any risk. I want growth, but I don't want any risk at all.
Right.
And then, of course, you meet the people who wants to be safe. Hey, I want nothing to be aggressive, just so you know. I don't want to be aggressive, but I want growth, but I don't want to lose a penny. So
I want my cake and to eat it too.
Elizabeth, I wanted to reiterate, because I think you really touched on some very important things. So 3 things that people confuse are these words: diversified, conservative, and safe.
yes, very much so. So, they are not interchangeable. To diversify your portfolio, you can actually lose up to 25%. And we have seen that with people who say that, hey, I am diversified.
Oh, and a big correction, for instance.
Yeah. So
Yeah.
it's a little bit of this and a little bit of that and all that stuff that they put together. But, if let's say someone has 800,000 and that they could potentially lose about 200,000 in a decline market. And we've seen that where people come and goes, hey, you know what? My advisor didn't tell me I could lose money. Well, you have to have that conversation, like you mentioned earlier, Steve. You have to have that conversation about how you are invested, the importance of your age, like we mentioned, or you're not 45 anymore. If you're investing like you're 62, you're going to have a serious conversation with your advisor.
Right, absolutely. And one question I love asking people is this: if your portfolio dropped 20% tomorrow, would you still sleep soundly tonight? Most people, their immediate answer to that question is, absolutely. Then I ask, well, what if I told you that's a $300,000 loss? Suddenly everyone reaches for the coffee and gulps really hard. Here's a phrase that I love.
Right.
Would you rather be rich, or would you prefer to guarantee you will never be poor?
Is your definition of safe the same as what the Hollands think the definition of safe or safer might be? Get educated. Ask questions. The Hollands are here to help. That's why we do this radio show. What questions do you have? Would you like to get a second opinion? Would you like to see if your current advisor or broker is on track with what your beliefs are? Get a second set of eyes on it. Get an independent set of eyes and see what the Hollands have to say. The Hollands will give you that second opinion. They'll build you sample plans. They'll build you an investment strategy. They'll build you a full retirement plan so you can look at what the Hollands would do differently. And again, it's a phone call away or a website click away. Call the Hollands, complimentary, no obligation. I was just talking about building portfolios for you to show you what they would do for you differently. There's no cost to this. There's no obligation. There is no commitment. All you have to do is call and ask. It's as simple as a phone call or a click. 727-228-6449. That's 727-228-6449. Or go to the website, askthehollandgroup.com. That's askthehollandgroup.com. Very top of the page, click on Discovery Call, and you set the time and date that's convenient for you. It doesn't get any easier. That's as easy as it gets. So call or click. If you miss the information, we'll give it to you again in just a couple of moments. Let's move on to why performance is not the same as planning. Elizabeth?
Oh, absolutely. Too many advisors, MJ, spend annual reviews talking about what did we make instead of what could we make? Well, what could happen? This is such a different conversation. If someone were to, if my advisors ever said to me, what did we make? My question would be to him or her, how much did you make from my account?
Right.
Let's reverse this a little bit.
And especially if you're correlated to the market and you're just invested in the market. Let's say the market's up 14% and maybe you made only 12. Well, why did I make 12 when the market made 14?
Right.
It doesn't make any sense. And then, of course, what creeps into that conversation is, what the heck am I paying you for? I could do that on my own. So every advisor, we know this, every advisor out there loves to talk about the years that the market goes up. The real value, well, what happens to the portfolio during the years that markets don't go up. Any investor, any advisor can look like a genius in a bull market, right?
Right, for sure.
They just look, hey, here's where you were the last time you were in. Here's where you are now. This looks really great. Retirement planning earns its paycheck during bear markets. Your advisor's talent will shine during bear markets, not bull markets. And I think that's really important. So one of the things that we have to talk about is, have you ever stress tested your portfolio? Do you know what would happen to your portfolio if we had another 2008? If we had another pandemic? Hopefully that's behind us forever, but you never know. What about a 2022? We call that the inflation crash. Stocks and bonds lost about 16%. And what about Trump's ever so famous tariffs? What about, the recent tariff volatility? None of these last forever, but they all feel like forever while they're happening.
Yeah, these are black swan events, essentially, many of them.
They certainly are. And you have to ask yourself, okay, during those time periods, again, 2008, COVID, 2022, even in the year 2000, what would have happened to your portfolio, especially if you were taking income from your portfolio?
Oh, it'll drop, obviously.
It'll drop, and it will drop big time.
Yeah.
And there's a possibility that recovery would not happen.
No.
You would not be able to recover. The S&P 500 declined approximately 57% during the financial crisis, 34% during COVID before it started to recovering. And it's not whether markets correct, it's when. This wonderful bull market ride that we're on right now will come to an end. It could start tomorrow. It could start in 2, 3, 5 years. Who knows? That's the way it works. That's why remember, Elizabeth, we were talking earlier about different phrases. Well, one of the phrases that we have been saying on the radio for more than 20 years is nobody has a crystal ball that actually works, right?
Absolutely.
So,
we definitely don't have one that works. We have one that just sits there as a paperweight.
That's right.
That's the bottom line.
It's a beautiful paperweight,
Yes.
right?
Yep.
But it doesn't do a thing.
What's the phrase that pays? That's the old, radio slogan, the
Right,
phrase
right.
that pays. Or how about the Tookie bird,
Right. The Tookie bird.
There you have it. Yeah, you look at the statistics, and, I want to point out something, that the Hollands can talk about the statistics because they've been through the statistics. The Hollands have been around since 1993. Folks, that is over 33 years. Look at what you guys have been through. And then even prior to starting the Holland Group, you guys were through the 87 crash, for instance.
Right.
You were through all these times. Then, you were working for other companies at that point, but then you started the Holland Group in 93. And look, you were in business 7 years with your own nameplate before the dot-com crash in 2000.
That's right. Yeah, that's right. So we've seen all of this stuff. We're seasoned advisors, and there's a lot of advisors out there that talk about this stuff, but they were in,
diapers.
They were in middle school, or possibly diapers, but maybe not. But
they were on a field trip to the Lowry Park Zoo. All right?
That's right. In a big yellow school bus.
There you go.
So I hate those trips.
727-228-6449, the number for the Hollands. 727-228-6449. Call up. Ask for a second opinion. Any questions? What do you have that's bothering you? Would you like to ask Steve and Elizabeth Holland a question to see if you get a different answer from them versus your current advisor? Get that second opinion. Get the Hollands to build you complimentary, no obligation, no cost to you, no commitment. Get them to build you their idea of a retirement plan and a full investment plan for you, customized, and take a look what they would recommend and why. That's why we do the show, to introduce you to the Holland Group, a fiduciary firm that has been here in the Tampa Bay area since 1993. 727-228-6449. That's 727-228-6449 for the Holland Group Retirement Wealth Advisors. Or it is also very easy to go to the website, askthehollandgroup.com. That's askthehollandgroup.com. And click at the very top of the page where you see click here for a discovery call. And it doesn't get any easier. You pick the time and date that's great for you, what's convenient for you to connect with the Hollands for an introductory discussion. Again, this is all complimentary. There is no obligation to you. There's no cost to you. It's as simple as that, to get that second opinion or see what the Hollands would do differently for you. As we move on here on retirement success, timing matters more than returns. Steve, I know this is like winding up a toy and letting you run. So let's talk about timing versus returns.
Yeah, absolutely. And we're going to talk about something that I like to call walking through a retirement nightmare. So let's start off with a description of something that a lot of investors have never heard of. Elizabeth, you've talked about this many, many times on the show, and on our TV show, you've addressed this as well. The sequence of returns risk.
Yes.
Most people do not know what that means, but let me ask you a very generic question. What happened in the 90s in the stock market?
Oh, everything went up.
It went up. It was almost like the perfect decade, right?
Yep.
There were a couple little speed bumps here and there, but it went up like crazy. But if you retired in January of the year 2000, we hate to say it, but you were in the wrong place at the wrong time. Let's say you had $1 million and you needed, say, 5% income. So you needed $50,000 a year. And looking back at the market, it was averaging about 8% per year. So what's wrong with that picture? If I'm going to average 8% and I take out 5%, shouldn't I be okay? Yeah, everything looks fine, no problem. But here's the reality. In January of the year 2000, the market lost 9%. The next year, it lost 11%. The next year in 2002, remember 2001, 9/11?
Oh, yeah.
2002, a continuation of the problems with 9/11. The market was down 22%. $1 million portfolio taking out $50,000 a year is now $506,000. So
Ouch.
You've been retired for 3 full years and you've lost half your money. Okay, thank you, Mr. Advisor. Thanks so much. Now we go into 2003. The market seduces us and says, hey, friend, everything's okay now. Come on back. Come on back. The market went up 29%.
You want some candy?
Some M&Ms.
You want some candy, little boy?
Yeah.
Here you go. The market went up 29%, then 12, then 5, then in 2006 it was up 16%. Your portfolio is now up to like $638,000, and you've been taking out $50,000 a year. So it looks like you're back on track, but then boom, you got hit over the head really hard by a year called 2008. The market lost 37%. Your portfolio is now at $330,000. You hang in there and you keep taking out that $50,000 per year. And then by 2018, you have a zero balance. It's gone. It's all gone. And this, sadly, is a very good description of sequence of returns risk. And if no one's had this conversation with you before, that's a terrible thing, right? Because you need to be made aware of risks inside your portfolio going forward.
So, Steve, how many times have you heard from our clients when they come in to see us, I didn't know?
Exactly.
Nobody told me this.
Nobody told me.
Nobody told me this, because had I known this, I would have made a different choice.
They told me I'd be okay. They told me I'd be fine. They told me when the market crashed, just hang in there. Don't worry, hang in there. It's pretty tough to hang in there when you say have $500,000 and a year later you got like $350.
Yeah, nobody
You know?
wants to hang in there then. So, during your working years, markets, decline can actually become an opportunity. And we always say that it gives you that opportunity to invest more, to continue investing.
Right.
But during retirement, like you just mentioned, Steve, when you're withdrawing your money, constantly, and you need that money to survive on, well, that's a different game altogether.
Yeah, it certainly is. It certainly is. You know, again, I gave an example on that. Here's another one. Let's say you've got $600,000 and you need $40,000 a year. That is a little bit too high. We would be very cautious giving that type of advice. We don't think that's great advice because your withdrawal rate is like 6.7%, so too high. But let's say that the market fell 30% and you still need that income. Well, your withdrawal rate now is about 10%. And that is simply not sustainable. So you have to identify your withdrawal rate. You have to make sure there's one word, I just said that word, one word associated with retirement success, and that's sustainability.
Right. So, Steve, you kind of sound like a younger person when you said, and, the market drops. I just want you to know that.
Did I, at the end of my sentence, go up a little bit?
Yes, you did. So just saying that. So it's kind of like eating your seed of corn. Once it's gone, it's gone.
Right. Yeah, that's for sure. I almost spit up my water on that one. You're absolutely correct. But these are the conversations, Elizabeth, that we have with clients.
Yes.
We make sure to say, look, life is beautiful, life is wonderful. Get out there and make memories, but we have to be careful. We have to play defense.
This is very fitting. John Lennon, Steve.
Everybody's talking.
Oh, right.
Nobody told me there'd be days like these, right?
That's right. That's right. Was this on his final album? His last album?
This was like 1980. This came out. I thought this came out posthumously. Maybe I'm wrong.
Yeah.
When did this come out?
I'm not really sure.
Yeah.
But anyhow, yeah. So he passed away. I think he got assassinated.
Yeah.
He got murdered. I think it was like
December or something.
I think it was like 1980.
Yeah, I think it was December, or it was early December of 1980. Yeah,
Right.
Yeah,
but
December.
when you guys were just talking, I was like, nobody told me there'd be days like these. What was that song? Oh, the John Lennon song. Nobody told me there'd be days like these.
See, that is the curse that musicians and DJs constantly face. We go into a song because a conversation will remind us of a song that even if it's 20, 30, 40 years old.
Okay. Then I'll remember that, Steve.
Right.
727-228-6449. Please call the Hollands. They're here. They're at your disposal. They would love to help and answer questions for you. The Holland Group Retirement Wealth Advisors. They want you to achieve retirement success. Start a conversation. Complimentary, no obligation, no cost to you. Ask questions. Let the Hollands build you a sample portfolio. Let them build you a full retirement plan and show you exactly what they would do differently for you. A fiduciary firm for over 33 years here in the Tampa Bay area. 727-228-6449, or go to the website, askthehollandgroup.com. That's askthehollandgroup.com. And just ask for a time and date that's convenient for you. And that's as easy as it gets, folks. You pick the time and the date. Just go to askthehollandgroup.com, top of the page, click on Discovery Call. It's that easy. Or just call the office at 727-228-6449. When we return, investors are emotional. Even the smart ones. Next.
Hey, Sean Hannity here. Unless you want to pay more in taxes than you have to, you should pay attention to what I'm about to tell you. As you know, President Trump's tax cuts have been extended thanks to the One Big Beautiful Bill. What you may not know is that right now, right this second, is the time to start taking advantage and locking in lower tax rates. Do you know who can help you get it done? Steve and Elizabeth Holland and their team at the Holland Group Retirement Wealth Advisors. Now, all you need to do is call 727-228-4673. That's 727-228-4673. Now, you don't want your hard-earned money going to Uncle Sam to be wasted. It's your money. Keep more of it. Steve, Elizabeth, and the team at the Holland Group can show you how. 727-228-4673. Don't wait. Find out how you could be saving saving in taxes for retirement with the help of Stephen and Elizabeth Holland and their team at the Holland Group Retirement Wealth Advisors. 727-228-4673.
Welcome back to Retirement Success from the Holland Group Retirement Wealth Advisors. Once again, I am MJ, Todd Schnitt, along with Steve and Elizabeth Holland from the Holland Group Retirement Wealth Advisors. If you want to get a hold of the Hollands, have a conversation, ask questions. If something triggers a concern on today's show and you'd like to know how it applies to you, please, by all means, call the Hollands at the office. Complimentary, no obligation, no cost to you. Let the Hollands build you a retirement plan. Let them build you a portfolio, an investment income portfolio to bring you money every month. Let them show you what they would do differently than what you're doing right now. 727-228-6449. That's 727-228-6449. Or go to the website askthehollandgroup.com. Investors are emotional. Even the smart ones, right, Elizabeth?
Oh man, that is so accurate because nobody, really enjoy watching their life savings decline. If you're a doctor or an engineer or a business owner or, retired CFP or CFA or whatever it is, emotion doesn't really care how intelligent you are because, whatever your profession is, try losing money. See how you feel.
That's right. Nobody's exempt.
No
right?
one is exempt from
No one
it.
is exempt at all. And you know what's crazy about the market is the market has a very funny way of convincing people to sell at a low. Why sell at a low? Well, because you should wait until the dust settles. All right, wait till the sell-off stops, and then things will be much better. Buy back in after things recover. Wait till things recover and things come back and then buy back in. This is exactly backwards. It's the worst advice, but that's what people do.
Would that be backwards?
Ass backwards.
I was looking for that word. And it was right behind me.
People do have a really strong behavioral problem when it comes to the finance. Because you know what? They're not educated on it to say, I better be strong about this. I know what I have. Maybe they're not working with a financial advisor who actually told them, you have to have, discipline. This is for long term. This is what we do with our clients. When we see the market is, being very volatile, what do? It's time for us to pull the reins back and rebalance the portfolio. So many people we talk to, Steve and MJ, they have no idea how to rebalance the portfolio.
No, they don't. And, you don't have to have one philosophy for all of your money. You can divide it up. We talk about this, and we talk about different investment segments.
Yeah.
Maybe you have $100,000, $125,000, $150,000 where you say, okay, I'm going to need a new roof within 3 to 5 years. I'm also going to need to replace my car, and we also want to take a bunch of trips. So maybe you want to go short term with that money as far as investment allocation, and maybe you want very little, if any, risk, and maybe you have other segments of money that you can go out longer period of time. But you're right. You were talking a little bit about behavioral finance. Nobody really teaches this to a client. We spend a great deal of time really helping a client get educated on how to behave with their portfolio. First of all, you have to truly get to know yourself. You have to know how comfortable you are with portfolio risk. You have to know that you're going to ignore headlines and ignore geopolitical nonsense. You're going to be okay with some of the fear that's out there. We just released our new book, Elizabeth, Greed and Fear. And Greed and Fear is all about identifying the greed, identifying the fear, and the problems that come with both of them.
Yes.
Right? And how to build a successful portfolio. We sometimes call it the CNBC overload, the Fox business overload, or the Yahoo.com finance overload, where people go and check this out all the time, and they check out the market practically on a daily basis.
So I have to tell people, how often do you check your accounts?
Right.
Oh my gosh, it's on my computer. So during work, I just click on and see how am I doing, and then I get really upset and I get distracted, and I can't even function because I feel like I'm losing money. If I'm gaining money, if I'm doing well, I'm so excited. I stay on it.
And then I go out for lunch, and I'm in the line at Chick-fil-A, and I pull out my phone and I check it again.
Everywhere to check it. So they check it more frequently, I would say more than 15 minutes a day.
Right.
More in increments. They certainly can do that.
Right. Yeah.
So maybe the biggest risk isn't always the market. Sometimes we're the biggest risk, right?
Yes.
Right. Absolutely. But you have to educate the client on the fact that your money has different strategies, and some of those strategies may be long term. And what happens today, what happens tomorrow is absolutely irrelevant of, 5, 7, 10 years down the road.
But so much of what happens in the news cycle, or Steve, you mentioned geopolitical events, so much does affect the market, and people will get sucked into a lot of the news headline-driven issues and how the markets fluctuate.
Right.
Now, how often do you tend to rebalance? On average, let's say over the 10-year span from, let's say, 2016 to right now, 2026, how often do you tend to rebalance portfolios?
I would say
per year.
Yeah, I would say 3 to 4 times per year.
Yeah, per year.
Depending on the year, but 3 to 4 times per year. Yep.
727-228-6449. The number to get you right through to Steve and Elizabeth Holland at their office right here in the Tampa Bay area. This is not some firm that's hundreds or 1,000 miles away pretending to be local. Nope. The Holland Group was founded right here in the Tampa Bay area in 1993. Here in 2026, 33 years later, the Holland Group is still here, based in the Tampa Bay area as a fiduciary firm. Any questions, anything that has arisen that you're wondering, how does this apply to me personally? The Hollands can get much more personal, obviously, on the phone or in person, and they would love to extend that invitation to you. Complimentary, no obligation, no cost whatsoever. There is no commitment. Have a conversation. Have the Hollands look at what you're currently doing and see what they would do differently, because it's all about retirement success. Call the Hollands at 727-228-6449. That's 727-228-6449, or go to the website, askthehollandgroup.com. That's askthehollandgroup.com. And the Hollands will be happy to work with you on a time and date that works. In fact, when you go to the website, askthehollandgroup.com, very top of the page, right below the Holland Group Retirement Wealth Advisors logo, you're going to see a link that says, click here for a discovery call. You pick the time and date that's convenient for you, and the Hollands will make it work for your initial interaction. How much easier can it get than that? You pick the time and the date. It is easy peasy. It is as simple as can be. Go to the website, askthehollandgroup.com. If you missed the information, we'll give you the contact info again in just a couple of minutes. Let's talk about portfolio stress tests. I would like to ask our listeners, have you actually ever seen what a portfolio stress test is?
Yeah, it's really cool. I mean, I like to call it our investment time machine, because here's what you do. You take your portfolio that you have today. We would take your last statement and we would put it into the software that we use. We use, Elizabeth, about 6 to 8 different companies for
portfolio
analysis and different things that we do. So we type this into the software, and the software says, okay, great. Thank you very much. Now let's fly back in time. Let's fly back to 2013. What a year, 2013. In 2013, the market made 32%. The S&P 500 was up 32%. It was one heck of a year. Fantastic year. Now, we all know what happened in 2008, what happened in 2009. So this software that we have, it will say, in 2013, if all of your money was in the S&P 500, you would have made X amount of dollars. In your portfolio, you weren't invested 100% in the S&P 500. In the breakdown that you provided to us, here's what your portfolio would have done. And this isn't, to the 10th of a percent. It's on average, but it gives the client a very good idea of what would have happened. Especially, why is stress testing so important? Because 2008, 2002, the pandemic, all of these things, as MJ mentioned, black swan events, they will be back. They will happen again, and you need to know how your portfolio would react. Has anyone ever shown you what would have happened to your portfolio the way you're invested today? What would have happened in 2008?
Or even, Steve, COVID, or if the interest rate stayed, elevated. Or how about inflation average about 4%?
Right.
Planning should really be something that you ask all these questions. Not simply celebrate what happened, but you have to be cognizant to what could happen.
Right. You definitely do. So one of the things that we have, I started getting a subscription from Morningstar back in like 1990. And I remember Morningstar back then. This was before the internet, really. And Morningstar was delivered by our UPS driver. And he would come like every 3 months, and they'd give me, 30,
a CD,
40.
Wasn't a CD or
No,
something?
before the CDs,
Oh, wow.
before the CD-ROMs. It was 30, 40 pages, and it went in a 3-ring binder. And they'd give you instructions like delete page 45 through 91
Update,
or what have you, or destroy it and put these in there. And then, of course, the internet. Then we went to, the CD-ROM. And then now today, Morningstar is updated every 30 days. And here's the thing, though. A lot of people think, oh, Morningstar, I have access to that, too. And the answer is no, you don't. You have access to the free Morningstar on the internet. What we have is when we do a portfolio analysis, it's a 35 to 45-page analysis. It's very, very comprehensive. It talks about risk scores and historical returns and standard deviation and your alpha, your beta. It gives a complete breakdown on your entire portfolio. And again, this is only one of about 6, 7 different pieces of software. I didn't mean to say 6, 7.
But this is extensive. This is not some superfluous little quickie pamphlet or something that fits on a fortune cookie slip.
Right, absolutely. And Morningstar, what they try to do, it's pretty impressive. They give you stuff on the internet for free to show you what you can actually have, and of course you'd have to get a subscription to them.
Right.
I think we're spending about $4,000 to $5,000 a year on our Morningstar subscription, and then, as mentioned, we have many others because it is so important to analyze where you are. How do you not analyze a portfolio? It's your starting point, right, with a client.
So I just want to mention this to our listeners because our listeners feel like, okay, I could get Morningstar and do the same thing.
No, they can't.
Exactly.
Right. They
Thank
can't.
you.
I mean, they may be able to get the same software through a different advisor.
But they want to do it on their own.
Right. But it's who is going to interpret it? Who are they going to work with? Are they working with an advisor that's got 30 plus years experience and can really explain what has happened historically to their portfolio over time?
727-228-6449. Again, this is complimentary. There's no cost to you. There's no obligation. Just call the Hollands. Ask away. Ask your questions. 727-228-6449. Book an appointment. Meet with the Hollands. Or go to their website, askthehollandgroup.com. That's askthehollandgroup.com. Click on Discovery Call near the very, very top of the page, and you pick the time and date that's convenient for you. If you missed any of that information, it's coming up again in just a couple of moments. So, retirement is not just about investments. What else is it about, Elizabeth?
So one thing we wish more people knew, and this is what in our field we're very comfortable with, investment are only one piece. Retirement planning is much bigger. When we talk about retirement planning, we're talking about an entire picture of your lifestyle. how you live, how you're going to spend, what your investment portfolio is going to look like in 10 years, 5 years. We talk about tax planning. This is all part of your retirement planning. It's just not one piece.
Right, exactly. So it's income planning, it's tax planning, it's Medicare, it's estate planning, RMDs. That's a big thing
Huge.
for
Yeah.
clients that are getting to the RMD age. Social Security timing. When do I take Social Security? All of these decisions affect one another. You know, a portfolio can perform well and a retirement plan can still fail. That's for sure. It's kind of like buying a brand new car. You buy this brand new, beautiful car, and you forget one thing, Elizabeth. Imagine if I go out and buy a nice, beautiful car, but I forget to put gas in it.
Oh, that's kind of like...
Where are we going?
Yeah, we're not going anywhere with that.
Let's take a couple of minutes here and let's talk about the building of different segments of your retirement plan.
Yeah, absolutely. So everything doesn't have to do the same job. You don't have to have one big fat portfolio and say, okay, I'm a moderate investor and I'm just going to grow this. Some money is designed to generate income. Some is designed for growth, and some simply needs to remain liquid and protected, of course. And each segment has a separate purpose.
So some clients, have the understanding that they stop reacting to every market headline, and we just talk about that.
Right.
They spend a lot of time looking at their accounts every 15 minutes. They have it on they have it on their computer at work. They have it on their phone at lunchtime. They have it all this accessible to them.
Right.
So this is something that we look at and say, okay, you don't need to go chasing the headlines, because every dollar you have means something and it's a sign for something. I look at it and I say, income segment is important. Growth segment is important. Liquidity, like you just mentioned, is important. How about legacy? All that's important.
Yeah, some people could care less about legacy, but for a lot of people, it's incredibly important.
Right. So our legacy for our clients, most of our clients say to us, hey guys, my children has done well. It's our turn. We're going to enjoy our money. We're really going to have a good time with all the money we have accumulated. Our children have just done so well. Whatever is left, they can have.
Right. They'll get the house.
They'll get the boat.
We hear that a lot,
Yeah.
right? They'll get the house, they'll get the boat, they'll get this, that.
They'll get a timeshare, where I have to say sometime like, oh gosh, do I really want a timeshare?
Right. Yeah, there's a good chance they say, no, thank you.
No timeshare, please.
Right.
Guys, what are questions that every retiree should ask their advisor?
Okay, Elizabeth.
Yeah, I'll go
age
first.
before beauty? Or
Yeah.
beauty before age? Go ahead.
Oh, thanks, Steve. I'd rather take the age before beauty.
No.
But I know you're older than me. Okay, so how much do I really need in my life, right? People always ask, well, how much money do you guys really need to set a portfolio, to put a portfolio together?
Right.
How much could I realistically lose would be something most people should ask
That's
themselves.
a great question. Yep. A great question. And what about this one? What happens if I retire in the middle of a recession?
We talk about income and we talk about how we build income planning for our clients. I just saw a client a few minutes ago walked in because he's been retired about 5 years now, and he's asking about an income plan. He's asking, he said to me as I came into the studio, he said to me, I got it. I would be good. You guys put this income plan together. Right. This is great. And you know what? You guys showed me how I could protect my income.
That's right. That's right. Yep. So income has got to be protected. And of course, we move on to the next one, which is we truly believe nobody does this better than we do. It's that simple. How we plan for taxes. How do we reduce taxes? How do we make sure our number one beneficiary is not the IRS? Have you ever had this conversation with your CPA, your accountant, your tax advisor? Are you preparing your tax return by yourself on your computer, say with TurboTax or one of the other softwares? Are you getting tax reduction advice?
And most MJ ask about, how often do we rebalance? Well, you know what? We take a look at clients' portfolio. when we're doing reviews for them. And if we see they need to be rebalanced, we don't wait for the whole company to rebalance. We rebalance that portfolio immediately.
Yep.
So we're always looking at a client's portfolio.
So here's a question that we often get as well. How often do we stress test the portfolio? That's a great question. And when you set up your retirement portfolio correctly, you don't have to stress test it every 3 months, every 6 months, every single year. But it is important that we're going to revisit this in the future. And the other question that we get a lot is, when was my last risk analysis? Or we ask that. And what do people say?
Yes. So people would say to us, hey, you guys did such a great job that I am where I need to be, and you guys are always following my risks here. If something is not right, you guys call me in, and we have that conversation face to face.
And prior to us, they say, what's a risk analysis?
Right.
My other advisor never did that.
Right.
I never did that. It was never done in my 401k, that's for sure. So these are very, very important questions. What about this one? What is my plan if inflation stays elevated?
Well, that's a good one, because you know what? Each investment portfolio that we do, inflation is adjusted in the portfolportfolio.
That's right.
Very
That's
simple.
Right. Yeah, and we have always been talking about inflation, even when there was no inflation. And another one, I know we're running out of time here, MJ, but this is a very important one. Am I invested based on my age, or am I invested based on my goals? Well, hopefully you're invested based on both, right? Because if you are 65 years old, 62 years old, 59 years old, what have you, we take age into consideration. And of course, we have to map out your goals and make sure that it is correct. I think the bottom line here is, Elizabeth, simply this, that sometimes asking better questions gets better answers. And if you're not getting the answers to these questions, it's imperative that you do.
Today's discussion wasn't about creating fear. It was about creating awareness, because retirement shouldn't depend on hope. It should depend on having a plan. Call the Hollands. Get that plan. Complimentary, no obligation, no cost to you. Call the office, 727-228-6449. That's 727-228-6449, or go to the website, askthehollandgroup.com. That's askthehollandgroup.com.
If you have some questions that you'd like answered, it's just an email away. You can go to askthehollands.com or text the word retire to 474747 and ask your question. And Steve, Elizabeth, and Alicia will be happy to answer your questions.
Tampa Bay, this is Alicia Holland, DiBernardi here, advisor with the Holland Group. We are answering your question of the day, and I have Steve Holland with me.
Hello, Tampa Bay. It's great to be here. Love this segment of the show. I've often said it's my favorite because we hear directly from our listeners and, of course, our TV viewers as well.
Yes.
Write in with questions occasionally.
Yes, that's right. So, Steve, we have Rick from Bel Air who wrote in today, and he is asking, what's the safest way to generate income without feeling like I'm gambling my retirement?
Okay, so let's talk about the least safest way, going to the Hard Rock Casino.
I would agree.
Right, so that is purely gambling and speculating, and we don't want to do that, obviously, in retirement. So one of the best ways is to generate income without feeling like you're gambling your retirement away. You've got to have a plan. You've got to identify all of your costs and all of your living expenses is what I wanted to say. So if you know every single month that my living expenses are, say, $3,000, for example, then you want to generate $3,000 in income, and that should not have any risk associated with that. So you're going to get income from, say, a bank CD. You'll get income from, say, a MIGA, or you'll get income, which is a multiple year guaranteed fixed annuity. No fees, by the way. Or you'll get income from an income annuity, a annuitized annuity, usually no fees as well, or you'll get income from like an equity linked or equity indexed annuities. Yes, there are fees associated with that, But they offer guaranteed lifetime income, which, of course, very popular concept these days. And it simply means that, okay, I'm going to get income for the rest of my life. And if I live to 85 and I pass away, if there's anything left in my account, it goes to my family, it goes to my beneficiaries.
Yes.
But if there's nothing left in my account and I live to like 95 and I'm still alive, if you're still fogging up that mirror, they have to pay you. They absolutely have to pay you. Now, I'm not saying that this is the greatest thing since sliced bread and everyone should do it. Like every investment, every single investment, every single strategy has advantages and disadvantages. And you have to weigh it very carefully to see if the advantages outweigh, obviously, the disadvantages.
And that's such a good point, because it's oftentimes that majority of investors who are not informed yet, they have a true misconception that if I die, that money goes right back to the insurance company. And that is not the case. And we would never be able to sleep at night or
Right.
keep the doors open for over 33 years if we were giving advice like that and putting people in any type of investment structure that would do such a thing.
Exactly. Obviously, whenever you pass away, the balance of your account in everything we do goes right to your listed beneficiaries, whether it's a surviving spouse, your kids, or a trust, or what have you. We don't deal with any insurance companies that say, okay, we'll keep the balance if that's all right.
That's right. And there's such a psychological element of comfort that's associated with developing a plan and actually working with a retirement professional, somebody that specializes. This is our niche specialty. Okay,
right.
We are not doing retirement planning for people younger than me in their 20s or early to mid 30s. Like, we are focused on retirement planning, specifically pre-retirement phase and while you are in retirement, so that you could stay retired and not have to go back to work at 86 years old.
Yeah, that's for sure. That would be a disaster. I personally, I don't want to go back to work when I'm in my 80s. That's for sure.
Definitely not. Well, Rick, thank you for that question. And thank you, Tampa Bay. Keep those questions coming in.
Hi, it's Glenn Beck. They've changed the rules again. Isn't that how it feels? Social Security rules, retirement rules, taxes. It feels like they just keep changing the game. So if you're trying to retire, how do you plan when people in Washington just keep moving the goalposts? Here's the hard truth. If your retirement plan depends on promises from Washington, you don't have a plan. Look, I'm just saying this plainly. Republicans cannot be trusted forever. We're seeing the cracks in their resolve, and they will get no help from the Democrats to help you. This administration won't always be here to have your back. Political tides turn, and they always do. That's why more Tampa Bay families are turning to the Holland Group, Retirement Wealth Advisors, to create a written income plan that they control, not the politicians. Steve and Elizabeth Holland bring 75 years of combined experience, and they've been serving this community for over 33 years. Work with people who are right here in our community and know what it takes to retire. Call the Holland Group, Retirement Wealth Advisors, at 727-228-4674, 727-228-4674.